Okay, folks, welcome back. Okay, we're going to be doing another review of the Kiwi homework, and I'm going to be revealing some more depth of this price action that has transpired over the last 18 months or so. Okay, so we have the market profile was in a trending environment. We had a void in here. Price has only been delivered. On the sell side, no upside delivery's been made. Last up candle right for the down move. That's our premium PDA on the monthly level or bearish order block. And I'm going to apply the levels at which I use and how I do it. This is what it looks like when I have my own chart notated. This is the bearish order block or monthly PDA that I'm looking to reach up into for premium. And this is the first of the bullish order blocks. Each blue dashed line represents the bullish order blocks on the monthly level. And the dark lines are the mean thresholds of each respective order block that it originates from. The dashed line is the opening on the down candle, which represents the bullish order block. And the little dotted line in here represents the high of each respective order block. The little shaded areas in here in tan, that represents where the buying opportunities are, and we're going to look at those as we drop down the lower time frame. But let's do that now. We're going to move into a weekly time frame. Okay, so now we can see the bearish premium PDA up here, bearish order block. The mean threshold is the dark line. It also happens to be the opening on the last up candle on the weekly chart, which represents, again, a bearish order block. We also have a greater view of the liquidity voids in here and the gaps that are existing in here. So on the weekly chart, we have a fair value gap between this low and this high. So you can see the fair value gap on the weekly chart. So this is a weekly PDA that price would be reaching for from all of these respective buy opportunities, but ultimately reaching up into the monthly PDA. So before we get to the monthly, we have to look at the weekly PDAs that would resist price going higher or at least cause areas of consolidation. Look at the levels of each one of these bodies in here. It's respecting essentially the fair value gap in here because the goal was for price to get up here and balance this pocket of price action right in here where price is only delivered on the downside. You see the congestion of all the bodies peaking around that area. That's the fair value gap. Okay. Now I'm going to also apply the weekly levels in here. Okay, so now we have the weekly levels. And we have this down candle here, right for the up move. That's the bullish order block. The dark green lines delineate the mean threshold of the bearish candle or bullish order blocks. Where there are monthly mean thresholds or monthly PDAs that are very, very close to the weekly levels, I choose not to use the weekly level just to keep the clutter on the charts down to a minimum. The dashed lines in here represents the opening on the down candles. You can see the dotted lines in here represents the highs on the down candles. And again, where there's the opening and high being very close proximity to one another on the weekly, I'm not electing to do both lines for sake of keeping the charts clean. So I want you to take a look at how price has reacted to these levels. Okay, and again, please don't share this approach to noting your charts in your public Twitter or social media things. This is how I delineate my charts. I kind of want to keep that information, inside the mentorship. And then you probably are wondering, what's the big deal? They're just lines and such. But if you show the charts like this, eventually they're going to get to what it means if they just spend some time studying it. So again, just be mindful that you don't share this approach. That's the reason why I didn't do it in the last teaching. I just don't want it being shared because obviously everyone's going to want to share their charts with me online or with their friends and family about how they're killing it in the marketplace. I don't want this being divulged because obviously if you go through the respective time frames, you'll eventually see what they are. Okay, so the idea is when price has traded down below a monthly, this is a mean threshold. Now this blue line delineates the order block on the monthly level that's bullish. So it's anchored to that vertical dashed line. All this over here represents this bullish order block right there. The levels here that are anchored to this vertical dashed line represent the levels for the bullish order block on the monthly level that is beginning in January of 2016. This vertical line here, all of the lines that are anchored to it represent the monthly order block that begins in May of 2016. And then the respective vertical line and anchored points are referring to December 2016's monthly bullish order block. Now on a weekly basis, I don't do any anchoring points, okay, because it's directly right to the weekly chart candle itself. So I don't want to have any kind of additional vertical lines on my chart. This is the extent of what I do on my notations. Then I make day by day notations on a daily chart, which is what we're going to look at in a couple minutes. But for now, I want you to see how all of the boxes in here that represent the swing points that I asked you to look at for your homework, look at the sensitivity on these levels. Okay, first we have this level here, trading down to a weekly bullish order block. Now look what's happened though. We traded below the mean threshold of the bullish order block that was created here in the month of October 2015. So price trades through what would be deemed as support on a discount PDA or discount array. The bullish order block mean threshold gives way, but if it does, like any other PDA on a higher time frame level, we drop down to the lower time frame level to look for a respective discount array. In other words, if the monthly gives up its level, we drop down into the weekly to see what it's done. If it's nothing there, then we would drop down into a daily. And the same thing is done on a lower time frame. If we lose a lower time frame level, it breaks down, we go to a higher time frame level and look for a PDA that would support it. They're interchangeable. Okay, so you're going to be looking for all of these levels respective to what you're anticipating in terms of price. We see clear indication that the market wanted to go higher because we've overtaken this down candle right here. So that makes this a bullish order block. Two of these candles, bodies, that projected higher up, that qualifies this price swing. This is a strong likelihood for a rally should price trade back to that level. It trades right to the opening on the down candle or bullish order block, and price has a willingness to trade higher. Price eventually comes back down, goes below the mean threshold again of the monthly bullish order block, and then trades down below the previous opening on this weekly order block. So if it does that, we are still maintaining the idea that there could potentially be a long mean threshold. It trades down through it by a little bit and wicks away, consolidates around both the opening on the weekly and the mean threshold on the monthly right here, and then there's expansion. Okay, price has two of these candles bodies projected up. 1, 2, it gives you a qualified price swing. If it turns back to this candle's higher opening, it can be a buy. Price does that here, 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 and then here again, after it takes out a rejection block, which is the bodies of the candles in here. It wicks down through it. That's the buy. That's what you should have been seeing for this price swing. Price rallies away, comes back down, finds some support at what? The opening of this order block, monthly order block. Remember, the dotted line is the high on the monthly order block. Remember, the dotted line is the high on the bullish order blocks, and the blue represents in this chart the monthly bullish order block, the second one that begins in the month of January 2016 for the Kiwi dollar. Price trades down into it, finds some support, rallies away. Okay, remember, it's reaching up into initially this fair value gap on the weekly because we're in the weekly time frame. Once it hits this and closes in the range right here, do we anticipate further upside dramatically? It can, but we're anticipating what first? A potential pause or some profit taking because price has already balanced out this gap right in here. You see it happening here. That's just for the sake of completeness. The low on this is 73.18. The high comes in at 73.07, and then this high comes in at 73.25. So it certainly does go 7 pips into this low here to deliver price and balance out all just the sell side only. So price trades up into it to allow perfect delivery of price. Price comes back down, trades into the opening of the order block on the monthly level for May of 2016. That's what the dashed lines are. Price finds support there. Price rallies away, comes right back down, trades into this down candle's high, rallies away, trades up into the weekly PDA or low of the weekly bearish order block, then up into the opening of the weekly bearish order block, and fails to get to the mean threshold up at the 75.27 level. Price eventually comes back down, hits the previous order block in here, rallies again, up into, trading into the low monthly order block. Price trades down this time, goes through the bodies of the candles over here, trades through the bullish monthly order block's high, and finds support at the monthly order block's opening for the month of May. Finds some support after running out the bodies of the candles in here. The setup is rejection block coupled with the open on the monthly order block at the May 2016 level. Price rallies again in here up to mean threshold of the last up candle in here, and then trades lower, taking out this short-term low, and all the way back down into the mean threshold of the May 2016 bullish order block. Finds the support here, takes out the sell stops below this low here. Also, when we drop down into a lower time frame, we're actually going to see price comes back into this level for a fair value gap. Price rallies away, trades higher, and makes a run for the rejection block above these candles bodies that are equal in here. Wicks through that, and that's where we're at currently. We have not made it our way back up to the weekly high seen here, and we have not traded back into the monthly bearish order block again yet. And so the price is consolidating here. We're going to drop down into a daily time frame, keeping the levels as we see it here. Okay, here we're on the daily chart, and I want you to take a look at the order blocks that occur around these levels with the daily time frame. We have this last down candle here, the black candle. Price rallies away, comes back down into it, capitalizes new buying, rallies away. Finds the support at the weekly opening on its weekly bullish order block here. Trades away, comes back down into the order block here, mean threshold, supports it, supports the mean threshold of this down candle, supports it, rallies again. Look at the reaction here off of this particular open on the bullish order block of August 2015. That's the opening price. Very huge sensitivity off of this level here. Price trades down through the opening of the bullish order block from August here. Trades down into the mean threshold through it as well, through the open on the weekly order block, and then hits the mean threshold of the weekly order block from August, or from looks like it's September. The price rallies below, price dips below the previous low into an order block here, capitalizes longs, comes back down into the down candle here as well, new buying, rallies up. Look at all the consolidation around the monthly mean threshold from August 2015 and the weekly open from the weekly order block over here. A lot of consolidation. Then price expands up, consolidates back again at a new weekly order blocks open right in here. Rallies away, comes back, finds some support at the order blocks open at August still. Again, the levels find themselves sensitive again. How many times it trades there? 1, 2, 3, 4, 5. Trades in here. Now look what's happened here. See what's in there? It's a gap. Price gap down. Okay, so price has to do what? We only saw a buy side delivery here between the gap of this low and this candle's high right in here. This small little gap. Price is only delivered on the upside. To balance that out, it's got to come down, closed in that gap, a fair value gap, and then it's allowed to rally. We have a down candle right here, bullish order block, trades back down into it here, off of the monthly mean threshold of the January 2016 bullish order block on a monthly level, and at the opening of the bullish order block from August 2015. All that overlapping in here, price rallies away. Lots of support around the opening of the bullish order block on a monthly level for January 2016, which is this level here. Price rallies up, then comes down and falls through the previous monthly order block on January 2016, below the high of the order block of August 2015 to the mean threshold of the order block of January 2016. Doesn't get quite there, but it does get support around the opening of the October 2015 level. Price trades away, finds some support at the opening of the monthly order block in May of 2016. Price rallies away, comes back down, finds some support of the bullish order block, and the opening of May 2016's bullish order block on a monthly level. Rallies higher and comes back down again, takes out the equal lows. Here's your turtle suit, run on liquidity pool. Rallies away. We have bullish order block in here, a little small, little down one, and it's in close proximity to a weekly opening on a weekly bullish order block, and it's also in the weekly order block at the high. Trades down into that level, and also an order block on a daily level. So we have a nice opportunity to be a buyer here, with the expectation price will want to reach that PDA on a weekly level in the form of the bearish order block. Look at the bodies of the candles in here respecting this. Okay, that is the opening of the monthly order block, bearish order block rather. Price trades down into the weekly order block open and onto the monthly order block of May 2016, finds support, rallies back up, closes in the void in here up to the bearish order block, last up candle, and trades down, finds the support at the weekly high of the order block seen here. This is a weekly order block, so you have to go back out to a weekly chart and see that. So go watch the video again, you'll see these levels and where they're being drawn from. Price rallies up, fails to get any higher than the monthly order block's low, which is the dotted line here. Hits that level, and look at the sensitivity there. And coupled with, it trades up into the last up candle's low. And that low comes in at 73.97. The high on this candle at its peak, 74.03. So it was only 5 pips higher to get into this candle's bearishness. And then look at the sudden rejection right there. This is not random. Okay, price comes all the way back down where the sell stops are, clears those out, finds some support at the monthly order block from May 2016's open, rallies away. We have a void in here. Price trades up, finds some resistance in here, falls aggressively lower for sell stops below the lows here and here. We get down into the mean threshold of the order block from May 2016. Find some support here, the last down candle. Recapitalize here for longs. We have a void in here as well. Price trades up, closes in the void. Right up in here, bearish price action is now balanced out with bullish price action on the upside. Price trades through on old high up to the last up candle right in here. And that low comes in at 73.18. The high comes in at 73.12. Right in here. Oh, I grabbed the wrong candle. These are the last 2 up candles. The low is 72.93, so it certainly gets that. 72.93 and 73.12, so it certainly goes into that. And wicks eventually threw it all the way up into the buys of the candles here. Trades through it as a breaker block. The close comes in at 73.69. And the high comes in at 73.75, blows that out, and we are presently trading in no man's land. It's nowhere in sight for a present trade. Now we can take this and further amplify it by going into a 4-hour chart. Okay, here is the 4-hour chart of the New Zealand dollar with the monthly PDA and weekly PDA levels. You can see how price has moved away from that bearish order block on a monthly basis. Here's our first monthly bullish order block from August of 2015. And here's September, starting a new month. And here's the weekly order block, and look at the price action around these levels. Okay, we have a down candle right at the weekly order block's mean threshold. Price trades right at it, right there. Let me zoom in. Okay, so we have the last down candle at the level. Price trades into it here. Sensitivity rallies. We see price finding some support at the monthly mean threshold. Price rallies away. We have a down candle in here around the monthly bullish order block opening price, which is what these dashed lines are. Down candle, price rallies away, comes back down, trades back into the body of the candle, bullish order block at a level that we'd expect to see bullishness anyway, and rallies away. If you don't see that one, no problem. You wait for it to trade back down into it again here, right there. So you're getting back into the order block here. You can use the bodies of the candle here. All the way through here is just all one block. Or if you want to really reduce the risk, you drop down into this only this candle here. But mean threshold of these candles in succession puts you right in here for the mean threshold entry for a 4-hour basis, long entry. Look at the sensitivity here on a 4-hour basis. Same thing. Price responds, trades back above short-term high. Price trades through the monthly high on the order block, but finds some support in the order block on a 4-hour basis, rallies back above, breaks into a bearish order block here, rallies down, hits the opening for the monthly order block, finds some support, and then ultimately expands down, creating a void in here. 1, 2, 3 times it trades there, making supposed support, comes down, closes in that range. Weekly order blocks open, trades down through a little bit, and then creates a stop run or breaker swing, then rallies up, closes in the gap up here into the monthly open on the bullish order block, trades right to it. Look at the sensitivity there. Now these are real support resistance levels, guys. They're not contrived, they're not just thrown in here. All I did was move down from the time frames from monthly level, weekly level, and kept those levels on as a 4-hour basis. Nothing magical outside of the fact that the price is going to be respecting these levels because they're higher time frame algorithmic reference points. This is where orders are going to be put on to either establish new longs or to take profits. So that's why you're seeing sensitivity around these levels. Look at the reaction here. Below the bodies of these candles, rejection block below the candles' bodies, trades down into it for the monthly order blocks open. Look at the rally. Rejection block above the candles' bodies in here, wicks through that. We have 2 equal highs as well. Trades through that, blows that out. Look at the sensitivity off here. Monthly order blocks high. That's what that dotted line is. Trades down, takes the bodies of the candles out. Rejection block, turtle soup, rally away. Take out the high, equal highs. Are they supporting? Buying. Down candles, buying it. Down candles, buying it. What's it reaching for? The liquidity above here and above here. Price trades all the way down after failing to go any higher. Price falls precipitously all the way down through the lows, equal lows in here, down to the last point of institutional order flow. Consolidation in between the new monthly order block established at January 1st, 2017. That's what these levels are forming. We don't use those levels until we get into February because you can't use a monthly order block that begins in January until the following month. That means the levels become important at this point here. You can see that the weekly order block, mean threshold here, and a weekly order block open from a previous weekly order block is supporting price in here. Price finds support here again, and a weekly order block's open. And price rallies up. Look at the consolidation around the mean threshold of the January 2016 order block. Trades up into its high, consolidates, and then trades lower, finds some support at the previous month's order blocks open. starts to rally in here. A lot of consolidation between three price levels: a high on a monthly order block, a mean threshold on an order block, an opening of an order block on a monthly basis. Lots of consolidation around those levels. Last down candle, after taking a low, we're looking for price to rally up into that monthly PDA or bearish order block. Down candle, rallies away, recapitalize it after finding a return back to a weekly order block high. Price rallies away, comes back down to previous order block again, overlapping with a monthly order block's open. Rallies away again, taking out all the highs here, here. What's going to be resting above that? Buy stops. They run the buy stops, and now they're going to drop it lower. You have a fair value gap in here, and then liquidity's resting below this low. Price comes back up, balances out price in here. Can't get any lower. Runs the liquidity out below the bodies of the candles here. Support at a weekly order block high. Capitalizes the bullish order block here. Rallies. Are they buying at down candles? Yes. 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 Down candle. Buying. Yes. Institutional order flow is reaching higher. Take out the stops above the highs here. Rallies above. Can't get any higher. Failure swing. Failure swing. Breaks down. Reaches into the previous order block. And here, smart little bounce up into the liquidity void, closing in the range. Right there. Price finds sensitivity at a monthly threshold of a bullish order block in here. Trades down into, if it loses that level, where's it going to go to? The next monthly level or weekly. The only level we have in mind is the open on a monthly order block. Price consolidates, wicks down into a weekly high of a weekly order block that's bullish. Price reacts and is very responsive to that. Trades all the way up to a high of 60, almost 68.80. Really nice price rally all the way up there, and then creates a little bit of a void in here. We have a mitigation block. Last time price went up, it sold off. So any sales of the New Zealand dollar in here, if price gets back down to that level in a void, it'll look to balance that out. It does that in here. It collapses all of the shorts because they're underwater all through here, and then they're allowed to rally price again. Are they buying down candles? Down candle, rallies away, capitalizes. Down candle, trades back into it here, capitalizes it. Trades all the way up, takes out the buy stops above the old high. Failure swing. Buys at the candles, equal highs. Liquidity above in terms of a rejection block, and liquidity pool resting above equal highs. Last down candle, recapitalize it. Every down candle, they're buying more at those down candles. Price comes up, clears the buys of the candles in here, rejection block, trades lower down to a level of a monthly open on a bullish order block. Finds some support. Rallies up, takes out the equal highs in here, and this high here, buy stops pulling all around 69.80 level, trades all the way up to 70.50. Rejects, comes lower, finds some support again at the monthly bullish order block at the open. Rejects, trades through it, turtle soup, breaker, price swing, trades higher, all the way up into the last up candle right before the down move, bearish order block. Trades back down, sensitivity around a new level that we can't see yet until the following month in June of 2016. These are all anchored to June, so we can't reference that until we get out of May, and that becomes sensitive here. So now we have a little bit of a rejection away from that level. Trades through the mean threshold of May 2016's bullish order block. Sensitivity around the open of May 2016's bullish order block. This is the high on May's bullish order block. Price comes down, finds sensitivity at the open of May's bullish order block on a monthly basis. Comes down, finds a rejection block, blowing out the candles bodies in here, and then rallies higher. Reaches for the buy stops above this high here. Every down candle, they're buying, down candle, they're buying in here, they're buying every down candle in that gives them opportunity to build in more of a position that's bullish. Okay, price comes down, finds some support at the monthly order blocks open. And again, look at this level here. This is not a support resistance line noted by any other discipline. It's again only using monthly order blocks highs and open, and we're focusing on those as the most sensitive price points, but permitting price to come back to the thresholds of the middle of the bullish order block. Look at the sensitivity here on the high of the monthly order block. Boom, hits it, dead ringer, and coupled with a last down candle right before the up move, loaded deal. You could be a buyer right there. Rallies up. What's it reaching up into? Last up candle, right in here. Boom, hits it, sells off. What's below the bodies of these candles in here? Liquidity, not the wick, the bodies of the candles. Trades down through it. Any trailing stop losses are gone. Rallies again. What's it reaching for? Above this high, and it will look to go above this high. Price trades above the old high in here. Rejection. 1, 2, 3. Failure swing. Trades lower. Sell stops. Sell stops. Order block. Equal lows. Boom. All gone. All gone. All these sell stops that resting below here, that liquidity pool has absorbed all of that. Then price sensitivity comes back in all around the monthly high and the monthly open on the bullish order block. Price rallies up, buying around the down candles. Price expands up, closes in all of the sell side delivery in here, up to the last up candle, bearish order block, nails it perfectly, comes back down, finds some support at the weekly order block high. Last down candle, trades back down into it. Are they buying it down candles? Yes. Price rallies away, trades back down into the last down candle, bullish order block, rallies. Last down candle. Didn't quite get to it here, almost got to it. Still some buying in there, but makes a run for the old highs back here. Buy stops are gone. Price comes back down into the last little order block here, big move up here. Sensitivity expected. Down candle, capitalizing, running it up, reaching above the bodies of the candles in here. All the way up above this candle's high, 73.39, and the high coming in at 73.41. And then one more spike through, failing to get to the monthly order block's low. Then runs through, hits the opening price on the monthly bearish order block, hits that rather handsomely, aggressively sells off. Now we're in no man's land. Notice how price gets very unorthodox. It's very choppy in here. There's no monthly or weekly order block levels. There's nothing in here to base trading on. See what's going on? See that? So price is doing what? It's waiting for more information or more liquidity to build up around the highs up here or below the marketplace. It's building open float. So when the market's doing this, it's going to seek out a higher time frame PDA, which is the reason why you have to use these monthly and weekly levels. Because if you don't have them, you're going to get chopped up and stuff like this. And yes, you can go in here and look at all these little ranges and say, okay, well, I could trade that on day trading. Yeah, you can. You can scalp it too. You can short-term trade it. But the highest probability trades are going to be around these monthly and weekly levels. You're seeing it. Chopped up, chopped up, chopped up. Boom, look at the response here. All the way down to this level, and then bang, there's a little bit of a pop. Trades down through it. Consolidation around monthly and weekly order block level. Now look at all the orders coming back in around a old monthly high, a weekly order blocks open. Finds some support and then rallies away. Closes in the range that was created in no man's land. This is all price action that had no basis for any kind of technical outlook in terms of institutional or algorithmic price delivery. And then look what happens. Price comes back to being sensitive again. When we get to a weekly order blocks high, 1, 2, orders should be populating that area or that price level. And look what you see. Price rallies away. Every down candle, buying it? Yes. Down candle, are they buying it? Yes. Expands up. What's it reaching for? Boom. Monthly bearish order block low. Hits it again. Sensitivity in the marketplace? Yep. Lots of orders coming in. Look at the responsiveness of price action there. Trades down here, gets a small little bounce on a monthly order blocks high. All the way down into a monthly order blocks opening price. Again, orders are going to be stacking around there. Price rallies away from it. Okay, trades back up. What's it trade up into? Closes the fair value gap right in here. Price is only been delivered on the downside. Price comes up, closes that in on the upside, then trades lower. Finds some support at a monthly order blocks high, which is the dotted line, and there's some consolidation around the new order block that's forming on a monthly basis in December 2016, but we cannot see this yet because the candle hasn't closed. So until we get to January 2017, this level and this level will not be able to be used. So we have to go through price action until we get to January, until we start seeing those levels become sensitive. So this level and this level are not important yet until this time in January. So now we can start looking at this level and this level here because they're directly anchored to this vertical line, which is December 2016's monthly order block or down candle. So now we can start looking at all these levels here. Now look what happens. Boom. We get sensitivity on the opening of the December 2016 monthly order block. Boom, boom, sensitivity, rally. Down candle, are they buying it? Yes, yes, rally. The last down candle, it was large in here during this consolidation. It capitalized there as well, rallies. All the way up into a monthly order blocks high. Support, support, support. We're in consolidation, trapped inside two levels, and this is where we're at presently. We're in no man's land, which is the reason why the Kiwi is going nowhere, because we haven't seen it trade to either a monthly or weekly PDA, where the large flows will pour into the marketplace. And this again is a 4-hour chart with monthly and weekly PDA levels in the form of bearish and bullish order blocks. And look at the sensitivity that you see here. This is not support resistance in a traditional form. It's institutional reference points from a monthly and weekly basis. So you can see where all the banks come in and how their orders populate around these levels. If you can't see these levels on your chart being traded to at the time you want to take a trade, it means you have very low probability of your trade panning out because there's not going to be institutional sponsorship behind your move. Notice how all the reactions that you get, these big pops, when you trade to these levels. You do not see a lot of very clear directional bias ideas when price is in between them. If it's hanging in between and consolidating, it makes it very less likely that you're going to have the direction right, or it's going to stay in a small range. All the times that it hits one of these levels, there's sensitivity in price because the orders will be around those levels. If there has been no other lesson in all of my content, even through all the free content that I've given as it relates to order block theory and institutional order flow and algorithmic trading, this is why I teach the way I teach, because I know this is how the orders come into the marketplace. This is where the banks build in their orders, and why the algorithm will go back to these reference points, because it gives them a chance to populate the marketplace with real orders to execute entries or take profit. So until next time, I wish you good luck and good trading.